Hey Devendra, welcome to the Startup Operator podcast. Thank you so much for making the time. So I have to ask your thoughts on the budget.
I think this is a landmark budget. I would probably compare the way famous movies like Sholay or Nazapna came and people did not appreciate and later than appreciated. Indian real estate is the most expensive in the world. It's cheaper to buy a flat in New Jersey City compared to what is in Gurgaon. Saving tax has not made any richer. Your parishram make you richer, whether you're a salaried class, whether you're an entrepreneur. Taxes are not unreasonable. 06 to 09, being startup founder was extremely hard. Capital was not available for startup founders. I would go and pitch to HNIs or businessmen of Jaipur and talk about venture capital, talk about entrepreneurship. And you would not believe, Roshan, I would get blasted post the meeting.
Hey Devendra, welcome to the Startup Operator podcast. Thank you so much for making the time.
Thank you, Roshan. Thank you for inviting me.
So Devendra, you've been investing for the last almost 11 years, 11, 12 years
That's
now, right? And in that period of time, startups itself have gone from something that a few people did to now being mainstream, right? There is a television show, multiple television shows, in fact, and pretty much everyone knows, right? Whether it's landlords or father-in-laws, everyone knows what a startup is and so on. And a lot of people seem to be interested in being a part of this whole startup pie itself, right? So how has investing changed in the last 11 years for you?
Yeah, so I think let me give a longish answer. So I've been investing since last 4 to 5 years as part of our micro VC fund Dexter Ventures. I've been advising companies to raise capital as part of the company Dexter Capital, which I started 11 years. But I have been, I would say, an active observant of startup ecosystem since 16 years, since I started working with a private equity fund called Olympus Capital. And I'll give a few data points. In 06, there are only 4 to 5 venture capital fund in India, which is Excel Partners, was Subrata, etc. Erasmic, Helion, SAF, etc. Raising capital was very hard. You would not believe Bessemer invested in a EPC company called Shriram EPC. They invested in Bessemer is like world's most popular venture capital fund. They invested in a company called Orient Green. This is a renewable company. They did not invest at that time. And they had 5 to 6 partners at that time. Similarly, for other guys. In 06, Your Story, which is the most popular platform, did not exist. So that started in 2008. VC Circle was run by a guy called Sahad. Cyber Media launched a magazine called Dare. And the startups that time, which unfortunately never got the capital, like Talil Brahma or Outgrew, those were being built.
Talil Brahma especially, right? I mean, think about the kind of innovation that he did in a pre-internet sort of a world, right? With those feature phones, basically.
Exactly.
Amazing.
Yeah. So even the InMobi guy was building that moves, right? So
correct.
I would say I would break the journey. 06 to 09, being startup founder was extremely hard. Capital was not available for startup founders. And if I just take the example of my batch, I graduated from 2005 IIT Bombay. I don't remember a single guy, including me, who wanted to become an entrepreneur, either because it's fashionable or either because it's valuable. One of the guy I know, which is one year senior to me, became entrepreneur 2 years later, was Harpreet and Vibhor, who built Co-Cubes later written a book.
We've had them on the podcast as well. Yeah.
Right? So it was pretty hard to become an entrepreneur. I think thanks to few people like Ankit and Benny, who founded Flipkart, and few people. And I would thank 2 people. I call them father figure for startup ecosystem. One is Sanjeev Hickchandani, who funded Policy Bazaar, I think, in 2008, and then Zomato in 2010. And another gentleman who is not Indian, but I'm really indebted to him.
Lee
Fixel. So imagine, right? Ola Bhavesh is my junior from Hostel 3 year. I'm 05 grad, he's 08 grad. His first round, I think, was probably 4 to 5 crore valuation. He not capital. I think he would have gone to every VC in the country. And Lee gave him a 5 million check when his traction was not, which by any means can justify a check. So if you think venture capital industry and valuation, these two are not even today well understood in country. Venture capital or a venture capitalist job is to provide capital to entrepreneur to build something where an opportunity that could exist, an opportunity captured. Let's say, take the example of LeafXL where he gave 10 million to Flipkart guys. And on Flipkart, I would want to tell, when he gave 10 million to Flipkart, at that time there were maybe 8 to 10 other startups which were larger than Flipkart. Fashion you raised like $48 million by likes of Sequoia, etc. Let's raise capital from Hillian, right? So it's about capital should flow to the best entrepreneur who can capture an opportunity which doesn't exist. And the capital should be adequate. If you give inadequate capital, the entrepreneur probably won't be able to build. So he did not give like $500,000, $2 million. He would have given $500,000, $2 million. Maybe Bhavish would have taken. Or he, instead of 10 million check, he would have given 2 million check to Binny and these guys. They would have taken. Right? So he gave that capital to build. From 06 to 09, when the capital was absolutely not available, this has changed significantly now. I talk about when I started building Dexter from Jaipur. I would go and pitch to HNIs or businessmen of Jaipur and talk about venture capital, talk about entrepreneurship. And you would not believe, Roshan, I would get blasted post the meeting where all these guys who are like gray-haired and seasoned guy who made money would blast me, and they will tell the famous word for venture capital in tier 2 town is vulture capital. Because these promoters don't want to give a single right. They want to cut. They make money. I have no respect for tier 2 to entrepreneur, but they make money by cutting corners on taxes. They make money by sometime ensuring that they don't pay the vendors on time, or by ensuring that the team is not sort of paid the kind of pay they should be deserving, right? But they will call venture capital, and I will give an example. Ola and Uber, they say कि नहीं ये सब loss बना रहे बंद हो जाएगी. I don't disagree with that, but when you build a startup, that's what is likely to happen in 8 or 9 out of 10 cases. Yet the value get created. The good thing is today, lot of I would say platforms or our peer like venture capitalists, we found a circle, go to these cities, hold events, and hordes of people will come and give capital. Some of them actually have become angel investors. Some of them become evangelists in this thing. Thai has a great contribution toward this city. So I see now the ecosystem has evolved a lot. Capital is available at every level. While I know, given I hear entrepreneurs daily, entrepreneur crib that VC don't give money or they don't give money easily, etc. But ecosystem has evolved a lot compared to let's say a Vinay from so anyway, Book My Show founder or Ashish or let's say the Vijay, the kind of headache that they have to go to raise capital in that time, I don't think that entrepreneur have to face. Though entrepreneur have to do good stuff. What still is lacking, that has been addressed a little bit, is that the funding is still not available for real innovation, deep tech, the way it would have been available in Silicon Valley. A few funds like Spatial Invest, a few deep tech fund, Nawam Capital or Sienna, they are trying to address that, or few individual HNIs are trying to address by putting capital. Overall ecosystem is a lot more favorable to become an entrepreneur. Failure is not stigma. You can still get married if you are an entrepreneur. It's not the question ki beta entrepreneur ban rahe ho to shaadi kaise hogi, and which is a real actual pressure that you have on you as a founder. So all that has changed, I would say. Another thing that has changed significantly, which you touched upon, is if you talk about two set of people who hold real money, Indian corporates, if you look at Infosys or TCS, like 10,000 crore of just money sitting idle, right? Or if you talk about a lot of family offices, none of that money was ever going into startups. The reason it was not going startup was very obvious. A, they were earning from stock market. B, they were earning from real estate. I think 2016 when Modi ji brought monetization, while that's still a debate, there is positive more or negative me, and I don't want to take a side. But at least that changed one thing, that real estate is not the game changer, return generating machine it used to be earlier, right? So that money started flowing. The second thing that started also happening with SEBI's change in, like SEBI brought some reforms in angel fund in 2012-13 AIFs and then 2019 angel fund. That money started flowing in, and we see a lot of family office get created. Dexter Capital had strongest relationship with family office in the country. We work with a lot of family office like Northam 60 family office or Anand Mangala family office. Now these family office are actively looking to invest in startups. Even like people like Mr. Ashish Kacholia ji or Mr. Mukul or Arpit, all these guys are now actively looking to invest in startups. And that's an extremely positive change. This budget actually incentivizes these people to invest in startup more. Earlier, they used to mostly invest in funds and they would use the co-investment money to double down. Now, these family office doing direct investing through their trusted circle. Some of those family office actually are creating their own teams, the way Northam 60 family office is created. Or some of these guys are now partnering with first-time fund managers, which is another tweet that we debated, and being either co-GP or an anchor investor, whichever it works with them, to launch newer funds. So I think the capital flow that's happening in country is a lot greater. And there's one reason, while there was a dearth of capital at Series B and Series C and Series D level, post the 2021 meltdown, capital flow was pretty ample at seed, pre-seed stage.
Seed, Series A, and then growth, right? Like pre-IPO types. I think, I don't know if people fully appreciate how big a deal it is that, family offices are coming into the startup investing world, right? Because, a lot of these folks they made their money through the typical Lala type of companies, right? Which, as you mentioned, they have very conventional business wisdom. Needs to be profit generating from day one. Now, explaining this concept of building something of value that might make losses for a few years and then make profits and have economies of scale at a later point in time may not happen. That's a huge shift, right? For someone to recognize, right? Wrap their heads around also. And these were folks who typically invested in fixed rate of return or maybe put some money in the markets at best, public markets at best, right? Real estate, gold, and markets in that order. These people actually coming into the startup investing world, I think, is a remarkable change. Really
Correct.
Remarkable.
Absolutely. So, look, every country goes through its own set of changes. If you see the history of Silicon Valley, it started in 1960s when people in tech side who came together and started building tech company like this thing, and they became the venture capitalists there because they saw the IPO boom, etc. If you see NYSE, it's like 200, 300 old year institution. Similarly, BSE is a 100-year-old institution, but BSE, for whatever reason, stuck in the old till that Harshit Mehta scam happened and NSE came, and NSE really pulled the stock market forward, right? Build the trust in the people. I think there is a real trust among HNIs today in Indian economy first and Indian entrepreneurs. And earlier, I think it was a taboo to lose money at two ends. Either by investing, you can make lesser money. आपने 100 रुपये invest किया, you can make 80 rupees. That was well understood. But people were extremely hesitant that it can become zero. Now they understood venture capital as a class कि out of 10 investment that you're making, if you want to make, let's say, 3x return, let's take the math, right? If let's say take 3x return, so even if 4 becomes 0 and you had an equal weighting investing, if your fifth company actually becomes 10 bagger or 15 bagger or 20 bagger, it will make 3x or 2x or 4x on overall portfolio, depending how you look at. And that is now understood by these people, right? So I think that money is started to coming in various shape. Part money is coming in, going to venture capital funds. Part of money is coming direct investing. Some of the people are becoming angel investors. And that's a very, very big thing, right? Because any economy fundamentally, if you take, which our Prime Minister also talks, if it's dependent on local resources, that's a lot better. So today we have best labor. India has the best demographic dividend in the world. People are talking that India would become most populous nation, or has already become most populous nation already, and it will continue to grow. we would have capital which would be easily available. Technology on public side, we are ahead. The only thing which was a more of challenge was land. Land was very costly, though that is also getting addressed. So I think India would run ahead in next 30 years like anything, and all the country would really appreciate the way India would grow in next 20-30 years. And a big driver of that would be recirculation of domestic capital, which I call capital formation. And that would really drive. If you just take the example, right? If you see like nearly hundreds of angel investors, which is Sachin Benny, Kunal Shah, Snapdeal founders, Titan. Recently, the story came out where they made around like whatever 100x or 200x in Urban Clap. All these guys are reinvesting because they were entrepreneurs. They are more empathy towards entrepreneurs. Investing. So there's a sizable pool of capital anyway who have benefited from that cycle 15 years. And we have capital which as you mentioned, old school entrepreneurs or Lala entrepreneurs, right? They are also investing. So I think overall it's a big boon for our country that capital is flowing. What government or our finance minister did yesterday is ensure that people are more incentivized to invest in startups or unlisted companies.
Right. How do you think the power balance between founders and investors changed in the time that you've started investing, right? I mean, or rather, since the time you know startups and so on, like 15, 16 years. I think in the early days, given that the funds itself were very scarce, the power balance was shifted more towards the investor side, I would say, right? But, we saw what happened with 2021 and so on and so forth, and Tiger coming in and writing a check a day type of thing, right? But today, I feel like, the power balance is slightly towards the middle, right? In terms of investors and founders, still skewing a little more towards investors, obviously, because they are the guys giving the money anyway. But it has come more towards the middle, right? How do you think the attitudes of, investors and founders have changed?
Yeah, I think if I talk about attitude, you also need to break up the segment of entrepreneur, because a person who is building a growth stage company is also an entrepreneur. A young company, which is tech company, is also an entrepreneur. Similarly, person who is investing in growth, which is we call it equity, is also investor in venture capital. So I would say power balance fundamentally, if I have to just define, would always gravitate towards entrepreneur in longer term. If I take an absolute like 30 or 50 or 100 year, the reason is because it's entrepreneur who is creating a wealth, and all the VCs and PEs are just custodian of money of somebody who has given them responsibility. So let me just give a very fundamental thought here, right? And that's where my company Dexter is being built on the very, very same principle, right? Everything that we see around the world, whether it's banks, whether it's bond market, whether it's stock market, venture capital, private equity, everything is nothing but different kind of product to solve only one thing: the trust. This economy has been existing 5,000 years and will exist for 5,000 years. Two things will remain always same. There will be people who want money, there will be people who need money. Money needs to channel from people who have money to people who need money. Banks was a system. Stock market is a system, right? Where primary market caters money and secondary market caters money, right? So they'll exist. So venture capitalists or private investors, I am venture capitalist myself and entrepreneur myself, right? I need to realize that I'm just custodian money. So a due respect needs to be given to entrepreneur. Now, the thing what happens is when you segment it out, then things getting more clear. So on a private equity side, entrepreneur is always the king. On private equity side, you will see partners doing the meeting. In fact, they're coming down and meeting entrepreneurs at their office. Even post-investment, all due respect is given. Even if they let's say on 26.
Because the founders are at a certain scale, right? I mean,
the reason is because founder have this very big thing ki if I don't take money, my survival is not dependent on you, right? That's a big question. And founders are also experienced. They know how to handle. They have done B2B sales. They have built company. They handled senior people, right? So they know how to handle folks as well. So practically, anyway, the equation is in favor of entrepreneurs. When I used to work with the lumpers, I know even before asking MIS or sending question to MIS, I would be extremely careful and caution how to word those things, or even the meeting how to conduct ourselves. We would sign NDA, no question asked before taking any data from the company. If company actually sends me an email, data needs to be deleted. Forget NDA, data needs to be deleted. I would actually go and delete it. Right? So that's the kind of equation that used to exist in equity versus entrepreneur. Why venture capital, the equation doesn't exist is, in India, first of all, capital balance was not there. There were, let's say, people who were provider of capital, in terms of number of people who were provider of capital, were few. Pre-2009, there was like 5 to 6 VCs. Then maybe number went to 20, 30. And the number went to maybe 80, 100. Now maybe let's say 300, 400, right? That's one. Second, India culturally has made B2B closer difficult. If somebody doing B2B business in US, it's closes faster than India, because India culturally had this habit of, if I'm in a power equation, I would love to negotiate. I would take my pound of flesh, right? Because this is my opportunity. So I think that sort of it's a culture behavior, I call. That happens a lot among the VCs. So people who have become VCs or people who are not GPs are more empathetic towards entrepreneur, because they have gone through the pain.
They also have more agency also, right? I mean, they can...
No, it's simple, because GP has gone through more pain in fundraising himself. So he understands that pain, right? But the person who has come to join a venture capital firm from, let's say, a consulting firm or an IB firm or a fancy degree, basically, he thinks, I have a chip on the shoulder and I have right to ask a few questions because I'm part of VC firm, right? So I think that happens a lot. However, I would say, so venture capital, you would see this equation change, This equation would always be in case of founders who are doing really, really well. These founders build company heads down, don't talk a lot. I'll tell, let's say there's a company called Pilgrim. It's built by one of my senior from IIT Bombay, Anurag Kedia. He's IIM Ahmedabad, and I invested in company at a seed stage when it was really an idea in Hyderabad. I get every week 2 calls from investor to talk about the company. Every time I talk to Anurag, he says, Devendra, I'm building. I don't want to speak to investors now. Investor wants to talk to me. You can make an introduction. I'm more than happy to have a cup of coffee. Whether I will talk business or not, I'll decide. Right? And there are 10 such companies that exist in the country today, which are being chased by entrepreneurs. I remember this company, Browsers for Stack. The founders were junior. I did not even know them. 1 year junior, I did not even know them. I got ping from every VC, or forget VC, every equity firm, कि देवेंद्र तेरे तो junior, तू जानता हो, please connect करा दे. And I did not know, right? I even reached on LinkedIn, etc. They never entertained, right? That happens. So equation fundamentally is in favor of good quality entrepreneurs. Let's just define it. But if you take an ecosystem level, given there are too many people chasing like a lot of VCs, we can say equation seems in favor of VC, especially in a current market where funding is not easy. 2021 market was different because it was not a very unusual market. These markets come in like once in 30 years kind of time frame, where because of fundamental things happening at other level, which I call a butterfly effect, right? Some changes happen in your ecosystem. So it was ZIRP, which is the mode because of COVID, because people did not know what to do and whether world will survive. So people went little bonkers to reduce the rate and keep the rate lower for extended time, which create the inflated flow in the capital market. And that also showed how shallow the venture capital market in terms of capital supply. Like if you just increase the supply by a few $1 billion, suddenly tide just swells. So I think that happened in 2021, where capital was chasing left, right, center to entrepreneurs and this thing. Another thing that happened is more a feature of market. All markets like venture capital or stock market, auction market. I'll give you a best example, auction market, movies that we used to Hindi movie, right? Art ka bolta tha, boli lagao, right? So auction market are always sway. An auction market would sway based on the local demand supply that exists at the time. या तो प्राइस ऊपर चला जाएगा नीचे चला जाएगा. That happened in that 2021 because it's an auction market. By definition, capital started chasing few entrepreneurs, so entrepreneurs started increasing price and increasing terms, and that happened. In long term, things will imbalance, and it gradually shift towards entrepreneurs. And it's my core dream that while I'm a VC, can it shift towards entrepreneurs more and more?
Will we ever see a 2021 market again?
for that, another COVID needs to happen. Another COVID.
God forbid.
So if a war happens, look, world is very smart, right? Like Darwin had said hundreds of years ago, that survival instinct, right? So as a humanity, our survival instinct will kick in. Central banks are extremely powerful, right? They know how an incentive mechanism in humans is extremely powerful, which Mr. Nirmala Sitharaman used yesterday, right? So they know how to gravitate the market. So without that kind of thing, I don't think that would happen. And another thing I want to comment is it's also about penetration impact. Like Japan has kept zero interest and negative interest for the longest time. It did not really happen, right? Because economy is extremely globalized today. So it's not necessarily that, let's say if entire world become global, all the world become developed economy, whether then even ZRP would be effective would be question mark.
What do you make of all of these founders who picked up, money at ridiculous valuations in 2021, right? And they now have to play a different game, right? Whereas it was all about growth at that time. I mean, now they have to think, or perhaps for a year, I mean, they've had to think about profitability, sustainable growth, so on and so forth. So people are okay growing 20-30% a year if you're closer to profitability, right? I mean, if you're reducing your burn and if you are near break even or even slightly profitable, it's a huge it's a huge chip up, right? So this difference, right, in approach. So how do you feel about founders having to play a different game right now? And you think these founders should listen to VCs in order, in to figure out what the business priorities are, how they should run their business? Because the same VCs were saying a different thing, like 3 years back, right? And today they're saying a totally different thing. But of course, I mean, everything is, like as you said, market driven. But what would your advice be for these founders?
So first, let's come to the crux of the problem. The crux of the problem that happened in 2021, and I'll define the problem that, as you said, where companies raised at very, very high valuation, where their numbers did not justify the valuation. So I consider part of three elements to the problem. One, the VC community itself, number one, which includes a new VC which is leading the round and existing VCs. Second, founder, though I'm quite empathetic to founders, so I would call, for lack of a better term, let's say ignorant founders, right? And third, media. So when you have a country, as Kunal has defined, which is status-driven country, right, where you seek validation, raising money at a higher valuation become validation for founders. It became their flex, it become this thing, it became their celebration. It became their status in their society, which was mostly ignorant. Ki, look, what you are doing is actually can bite you back. Let's talk about VC community. So no one talks about it. Maybe Chamat did one podcast in which he talked about it. But VC community has very purpose interest. It's not necessarily the company that you invest in, you have to exit. If you can actually raise new fund, a bigger size fund, which would draw 2% fee, right? That is making good money for you without delivering any exit for LP. And that 2021 market did that. The third is the structure of the asset class.
Wow. Wait, just go back to the previous point because
yeah. So
that's an important point.
Yeah, I'll go to previous point. So VC community, rather than generating revenue or profit, may be more incentivized to show markup. Because markup ensures, so let me explain the VC, because markup ensures that TVPI, which happens in 4 year of the, or first 6 year of the fund, which is you use to raise next fund. TVPI is basically what is the portfolio value today compared to investor capital. What's a DPI, which is the distribution that you provide to LP, right? So TVPI is the number that's looked by institutional LPs like, let's say OTPP or the lot of institutional pension funds, insurance company. So that is what they look at, right? If your TVPI is going through roof, you would raise new fund. I'll give you math. If you raise a $200 million fund, that's $200 million for new fund is like how much? 1,600 crore. On 1,600 crore, you're making 32 crore per annum. आप अपने 5 पार्टनर 10 एनालिस्ट को खूब बांट दो सैलरी 1 crore, 1.5 crore, whatever, right? Even then, you will make 10-15 crore of annual income business. Tell me which founder make that kind of money on a 10-year basis, right? So that's the one community that happened there, right? The second,
so these valuations being marked up
because existing
were used
investor,
to raise newer funds, basically.
Exactly. The structure of the asset class itself. When you raise a fund, you need to deploy that fund within 3 years. So there's a deployment pressure. Tell me, if you run a bank, right, should be a deployment pressure on HDFC Bank कि नहीं मुझे बांटना है, because जब बांटूंगा नहीं तो मुझे पैसा नहीं मिलेगा. Think of that कि interest income है सब fee income बना देते हैं, right? So that's basically the thing, right? So management fee 2% is fine, but that basically creates a deployment pressure. So a person who has raised fund in US because of JIRP, which is a 5 billion, 10 billion fund that we saw of Tiger, or 100 billion fund of Masa, right? The guy has to deploy, because if it doesn't deploy, there's no way he can justify this thing, right? So that's another pressure. So it creates a time sort of pressure, right? So the second and third is, though I should keep friendship, but I keep demonizing them, is media. Our media just started creating heroes out of nothing, right? People who have built company out of labor and hard work, rather than, I would say, these all funding celebration, unicorn. You see 2021 article and media would create hero. They would do award shows, etc. Right? So these are three things which happen. So if you see, let's say, A91 partner and his tweets, he would continue to tweet. I would tweet ki this thing. What happening is not sort of right? But unfortunately that happened. The good thing is ki the economics is self-correcting system. It ultimately had to correct.
People get wiser.
People will get wiser, right? A lot of people will lose money. So some of the LPs, let's say, lost money. But it would happen. It would make somebody's career to fantastic, let's say, or Karan get a fantastic exit in Byju's. And he's chilling in Goa, and Byju, obviously, is not because of Karan, but for all his folly, is now struggling, right? So some people would have humongous benefit.
Actually, Mr. Mohandas Pai also got a big bonanza from Byju's, right?
Mohandas Pai should be given credit for creating Byju. So before 2015, Byju was a great teacher, fantastic teacher. I come from a coaching class, and he was always a celebrated teacher. What happened out of 2015, whether Byju's fault or is investor fault, I am no one to comment on that, right? But Aryan Capital was the fund which invested before anyone figured out in them before 2011 and 13.
When EdTech was not even as popular. Right?
And that the power of family office. I always tweet, though all the VCs are my friend and I have to do business with them on Dexter Capital side and IB side and venture capital side, I have to co-invest. But India's first 5 to 6 unicorns were not created by VCs, and VCs existed then. 2006 exit kar VC. Policy Bazaar was created by Sanjeev Hickchandani. Zomato was created by Sanjeev Hickchandani. Times Internet was delivery was created by Times Internet. Byju first invested not by VC. It was Aryan Capital. InMobi first did not get capital. K Capital, Sasha or Mumbai Angel was investor, but he had to go to KPCB to get capital, and then has to run to SoftBank. So our VCs were conservative. If you see the example, I probably if somebody gives me a question, I can get more examples as well, where all these were created by VCs. MakeMyTrip was created by in VCs outside. Flipkart and Ola were created by VCs outside. So you see, the real risk taking did not happen because India never learned to take risk, or Indian entrepreneurs never take to risk, or LPs or GPs who are running never sort of, let's say, took the risk in the companies. We see that changing now. Now we see somebody like Nexus taking full on. I'm like, how to hugely admire the kind of conviction they've shown in Zepto, and Zepto is the father of e-commerce industry, right? So that's changing now for good. But otherwise, I think it was not done in past. Just to conclude the question that you asked, all the entrepreneurs who raise capital at higher valuation needs to fundamentally realize, and maybe we should coin a new word for valuation. Maybe it's a agreed valuation to split equity or something like that, the way we have this thing. Because whatever your valuation which you had created, the agreed valuation is a valuation to split equity between two folks, an entrepreneur and investor. आज से 100 साल पहले Tata Group and Mistries, Cyrus partner in that fashion only. That's how we see, if Mistries would not have happened, Tata would not have capital. And that's how they got equity of whatever equity, which led to ugly fight, right? So it's just nothing but split. And the reason the split is happening in certain fashion is because no one knows how large the opportunity would be, right? So you are taking a bet on an entrepreneur and agree to this thing, but whatever the agreed valuation is never an equity valuation. If you take 90 out of 100 businesses, if you try to sell those businesses, none of those businesses would be able to sell at the valuation
but the
that they agreed.
difference is so huge, right? I mean, if you look at 2021 times, it was not unusual for someone to raise at 30 times revenue, 40 times revenue, etc. I mean, I've seen deals myself, right? But today, I mean, if you look at platinum quality SaaS companies in the US, right, larger market and so on, right, it's trading at single digit, 6x, not even 8x, right, 8, 9x. This difference, right, what do people do? Because I mean, you'll have to really beat the laws of physics to kind of grow into the valuation that they have raised at, right? So
not necessarily. Who said that they have to grow? Public market, company goes up, company goes down. In private market, it can go down. Why there is that stigma or mental emotion? There's a contract that's agreed in every entrepreneur SHA that call is broad-based weighted average. A company which has been valued at, let's say, 100 million. Let's say that company's ARR is $1 million and it cannot raise capital. The entrepreneur and his investor need to sit together and figure out.
But aren't there these anti-dilution?
Anti-dilution is broad-based weighted average. Two factors. One is the valuations happen, capital is being raised. Raise lesser capital, grow into 10 mil wala thing. And these are all agreed formula, right? You can get it waiver off. Tell me which VC wouldn't agree to waive it off. It's entrepreneur's courage that needs to go and talk to the VC and say, ki, boss, my venture will die. Because if the venture dies, the VC loses the shit. He loses the entire capital. In this case, he gets something. I have fought on behalf of entrepreneur to get them MSOP. One of the company that we advised, Dehat, in the Series C, we got them like 4 to 5% MSOP of the entire round. So it's not this thing. The problem is ignorance. Problem is having the courage to go and talk in clear manner, refix the cap table, right? So it's not a problem at all. It's a problem which is made out.
These guys, whoever raised that kind of money, right, should sit across the table with the investor and agree on a new sort of a redistribution, right?
Yeah, so there are 3 things needs to happen. First thing that needs to happen is that, which is more of a founder needs to realize, then the investor and board probably needs to agree and support on the business plan. So there is a right called annual business plan, which is agreed in SHA in the affirmative rights. So people need to figure out that in new world where capital is scarce, the capital not available, maybe the business plan which was agreed that during the time investment may need to be redrafted. It's very, very simple thing. You go and have a discussion with the investor and you need to convince investor. So first thing is that, right? Second, if that business plan needs money, you don't have to, it shouldn't be flexing thing. You can raise whatever money you need at whatever valuation you need. Who is stopping you? It's just your board, right? And board is assembly of founders and investors. You agree to that. Keep that in your pocket and go and raise capital. If actually founder is somebody who actually has capital, they can just do the rights issue. They don't need to entertain existing guys, right? And rights issue can have a revised valuation. So this problem which has been made out so big is the problem once again because a lot of founders are not aware what they can do. It is their mental stigma. Ki boss, if I go to VC where I actually negotiated 100 million valuation, it's completely fine. If you see public markets, sometime IPO happen at a higher price, or sometimes QIB happens higher price. If market comes down, it will have lower price. It's not necessary that you would. Founder's job is not to defend the valuation, which unfortunately they get into. Founder's job is to ensure 3 things: am I progressing month on month, year on year forward? Am I keeping my employee or my customer happy? If founder solves for this thing, ultimately business will get built. वो business अब $1 billion बनेगा या $100 million बनेगा, $2 million बनेगा, $5 million वो बनेगा. One thing which is I would the Silicon Valley से उधार ली गई problem है, which is again comes from the same thing I said, the VC model, right? Sometimes VC don't want founders to build small companies. Because small company doesn't generate VC kind of return, right? Power law doesn't really come. So sometimes they say, boss, if you are building small company, shut it down. Return the capital. Return the capital to us, so shut it down, or this thing. So that's a different game
but
altogether.
then fundamentally, how does it work for the investor, right? I mean, because if I came in at an X valuation, and now you're saying you're doing a down round at X minus 20% or X minus, let's say, 50-60%, how do I make my money?
Let's take a cap table. Let's say founder on, let's say, 50%, let's say 3 VC on whatever, 2010, right? And the last round happened, let's say $100 million, okay? So if you do down round, let's say at 40 mil, 60% valuation, but if you only did 1 mil or 2 mil raise or 5 mil raise,
it will not be
because it's a broad base, it's not a full ratchet. Full ratchet doesn't exist now. Any VC who is signing full ratchet is an evil VC. Stay with that.
Just explain full ratchet for
full ratchet is
folks.
100 mil means my investment, which I invested 100 mil, will convert at 40 mil. Broad-based weighted average ratio means I invested, let's say, 20 mil at 100 mil, and now investing, or you are taking money from somebody else at 2 mil. So it is like weights. So that weighted average valuation would be closer to maybe, let's say, 80 or 90 only for this thing. So let the anti-dilution hit. If the anti-dilution is hitting, negotiate an MSOP. Let the anti-dilution hit you.
MSOP.
MSOP is basically the way we have employee stock option. We have MSOP. Which is management stock option, management of founder stock option, whatever you want to call it, right? So take the capital right now. If you think by taking this capital, it's a volatile journey, right? You came to 100 mil, then you came to 40 mil. Tomorrow you actually create a $1 billion outcome. Negotiate MSOP के बॉस 100 mil पे आए थे आप, अभी 40 mil पे ले रहा हूँ मैं पैसे क्योंकि मुझे ज़रूरत है, नहीं तो कंपनी मर जाएगी, मेरे पास खुद के पास पैसे नहीं, आप डाल नहीं रहे हो, मुझे बाहर से लेना है. If I create a value tomorrow from 40 mil to $1 billion, this X%, 2%, 5%, 10% needs to come to me. Because even in that scenario, you will still make 2 or 3 or 4x, may not make 20x, which you would have made. The problem is, Dexter fights a lot for founders, like anything. For any mother, we are very clear. 3 things is very, very essential to Dexter. We would not advise a founder who is shady. You can see a track record. A lot of shady company came to us. We would not advise. Wealth will be created by fusion of founders, creativity or entrepreneur, and investors' capital. Ultimately, founder in this asymmetric information world is a person who doesn't know anything about all the rights, etc. So he needs to be at least taught and educated, and then mutual negotiation needs to happen, which is not unreasonable given Indian laws. A lot of laws are unenforceable. So we actually side with investors when some of those rights come into play, like if you do fraud or if you need exit, etc. But the point, it has to be, wealth has to give. Wealth is created, वो share हो जाएगा. वो पाई बड़ा तो बनाओ. वो पाई को cut कैसे करना है, we'll figure out. If pie is not created, everybody is losing. At least let the pie to be created. So that's something. The problem is founders remain in so much shell. Founders generally are lonely. They are not. Their ecosystem like tie at early stage, but there's no ecosystem for founders who raise money. So there has to be an ecosystem for founders who have raised capital. And I get like, in a month, I get like more than 30-40 calls from people who raise capital, who call me like 3 or 4 days before board meeting. Kya Devendra, board meeting ho rahi, kya baat karni hai? So that ecosystem lacks in India, which needs to be created. So education for founder who raises capital, how to have a negotiation or a discussion with the investor, because most of the founder have never gone. Second time founder becomes smarter, third time founder becomes smarter about this.
But founder is wrong to take money at those kind of valuations. Like I can play, I mean, I'll try to steelman the founder's case, right? Someone's offering like an FU kind of valuation for me, right? It's a lot of money. I am building this business, obviously, to cause an impact and everything, but also to make money. And there's this huge opportunity to make money. And even if I make a little bit of secondary, that, my life is sorted, let's say. Number one. Number two, if I reject this is going to my nearest competitor, right? And they become stronger. Their ability to deploy resources, money, all of that stuff is way more, right? And number three is just plain FOMO, right? ये मौका नहीं आएगा आगे जाके. And as much as I'm a biggest believer in this business, I know that a business is like half chance, right? I mean, it's 50-50. आगे जाके अगर will I end up even making money, etc., etc. So for all of these reasons, let me just, जब पैसा मिल रहा है, लक्ष्मी आ रहा है, तो why should I, shut the door?
I'll answer in question multiple part, Roshan. So let's define this equation when founder in the kind of 2021 were being chased by investors who are offering them money at a crazy valuation. Okay, let's define that equation. First, is it unethical to take money? Answer is no. It is immoral to take money? Answer is no. It is illegal to take money? No. Let me go even further with somebody like Sanjeev Vikchandani has tweeted, and somebody has tweeted that some of these founders actually never created value for the investor, yet they did secondary and bought houses in like Magnolias, etc. And I know a number of them, a lot of them are my friends, etc. as well. Even, is that wrong? Let me once again repeat, is that it was a founder, when the founder was being chased and did secondary and bought some nice house for himself or for this thing, was it unethical? No. What is immoral? No. Was it illegal? No. What was wrong, given we are talking about it? The wrong was, it was imprudent. It was unwise. Because when you take somebody's money, हम हमारी कंट्री में सिखाया थी किसी का पैसा लिया तो लौटाओ इंटरेस्ट के साथ या रिटर्न के साथ में. तो when you are taking investor money, it is your duty, it is your responsibility that you would make money for them. A founder knows best about the business, investor cannot know. If he knew by taking money and by deploying that hordes of money into team or technology or product or marketing is not going to generate a value out of thin air, it's actually better to probably not take money. Now I'll come to the interesting question that you ask about competition. What will do if you don't take money because you're wise, but somebody else is doing it and you're destroying your turf? I agree with that. You need to defend your turf, right? So you would need to probably take money. Maybe take money. And this is where the advisors come into play. And advisors, I'm not, in India, I know investment bankers get demonetized and for right reasons, because out of 300 people, 90% are bad, right? But if you have a good advisor, probably the good advisor would advise you first to take money from a sensible investor whose source of money itself is not cheap. If you've taken money from a fund, I won't name the fund, but if you've taken money whose source of capital was so cheap that the fund never cared about putting the money and they would be okay to take write-off, it's probably not right to take that money, right?
Again, that's a very sort of unintuitive thing.
Yeah, you take money, you take in tranches.
Right, because why would you worry about that?
Yeah.
Right, their source of money.
And rather than taking higher money, the better thing to negotiate is, which is hard to negotiate with investor, is, I'm taking your money, but you cannot invest in these or 3 or 4 competitors. Whether it's a legal agreement or verbal agreement. In Dehat, whenever we took money, I and Shashank talked to investor, and some of them actually invest in competition, is we would like you not to take money, or you not to invest in money. And if you're investing, at least let us know before you are talking to them. For example, I advise Dehat, a company that advises for series A, B, C, D, E. And there's no written agreement, there's informal agreement. It's ki, Devendra, if you're advising competition, at least let me know, or at least it's a good faith arrangement. That's how business happen in India, right? Baaton ki value hoti hai. So you could do that, right? So if your only reason to take money when you do not need money and you cannot deploy that capital was to ensure that it doesn't go to competition, is the right reason. Let's just put it this way. Whether you want to do secondary, if you are doing secondary and enjoying life and just investing in other people's startup and not putting money, not putting this thing, this is wrong. This is definitely not, it's just prudent. I'm no one to call it unethical, but probably it's not prudent. It's basically that. So I think...
do you think there is this incentive structure itself has become little perverse in some sense, right? This week there was a news that the Qatar investment fund is going after Byju's personal assets itself, right? Whatever he owns. I mean, I've never heard of that before, to be honest, right? I mean, from an investment fund basically funding in startups, going after individual founders itself. But do you think that was, forget the specific case of Byju's, but do you think there is overall, because of the capital and so on, the incentives itself are sort of perverse right now, where founders think that, okay, you know what, let me race around, I'll take some money off the table, and if it happens, it happens, right? If I end up building a big company, I mean, sure, but otherwise the ride is kind of worth it, which was the opposite of the 2006 or 2008 times, right? Whereas it was pretty much all or nothing, right? And it was such an anathema to startup itself, right? Even forget about marrying or whatever, even getting a job after being a failed founder was impossibly hard. And I can say that it was almost as much even in 2017 when, as a failed founder, I was applying for a job, right? So do you think the incentive structure itself has to change? Or what would you change?
100%. So again, deep question, multiple parts, or answered multiple parts. I'll come to incentive structure maybe last. So first, let's come to founders. What is wrong and what is right? If founder doing secondary when investors are chasing him to be part of cap table and having a nicer house or nicer thing is, in my opinion, is definitely not wrong. Subject to that founder is ensuring that is not diluting his or her focus and the founder is continuing to build the company. However, if founder is taking slightest of money off the table for whatever means, whether it is hiring a friend who runs a recruitment consultancy company and you paid that guy and that money is coming back.
More common than we think, right?
I'm telling you each method I know right away in this call. Or hiring a marketing agency whom you're paying money and that money is coming back to you in form of cash, or doing capex and those guys are doing, or doing over invoicing. So I've been an entrepreneur. I am Marwadi Bania who built hardware. I've been a CFO. I've done diligence. So I don't rely on Big Four diligence, honestly, right? That's actually one of the most useless way of doing diligence in a company. And we see all the examples. While some funds are being made bad, but more than them, I think the companies which the agency which did right, the report should be made public and said that whether they discover that. It's not difficult to discover a founder who is doing bad just by looking at the numbers, etc. It's not at all. The thing is you need to go on ground and do the work. So that is really, really bad. If founder is taking money, so it's very simple definition. If it comes in public, whether your mom will feel bad about it, your neighbor will feel bad about it, and whether you'll be able to look in nice, it's as simple as that definition. आप चोरी करोगे तो खराब है, चोरी करना गलत है, right? So secondary transaction versus चोरी करना खराब है. That should not happen. If founder doing चोरी in whatever means and fashion is wrong. You negotiate higher salary than market. You do secondary. That's a negotiated call. It's an agreement between you and this thing. You may question prudence of that. That's a question. Now let's come to the other part, which is unusual, which you said, a fund going after personal asset of this thing. In a fraud, if an investor going after personal asset, that's absolutely okay. If you took money without telling me, and that money belonged to my LP, then you took it, and I want to go after a personal asset, I don't disagree with that, because how the ecosystem will fix otherwise? Otherwise, the ecosystem, the company law, people will take, in India, a lot of promoters have taken companies to insolvency, and in backhand, they got their friendly buyer to buy the company, right? That's a way to loot either creditors, investors. So, while it is unusual, especially done by a firm like QI or a global fund, etc., which is unusual, but I don't disagree with that. This thing, whether Baidu done anything, I have no idea. Right, I can't comment subject, but if they are doing that, maybe they have reason to believe and sort of do that, right? So in that case is wrong. Now come to the incentive structure. Incentive structure play a very, very powerful role in people's behavior. In VC's behavior, I said markups play a role in terms of. So let's take an example. If in a company, in fact, I was having a discussion while coming to you with a very seasoned VC, that hey, if I'm invested in a company and if I know something wrong and you are investing, you are my friend, my fiduciary duty is to my LP that if you are investing and you invest because the company becomes stable, but what do I do if I am a friend and I don't have an answer and he didn't have an answer, right? So the question is, what should an investor do if the person knows there is something wrong in the company and somebody else is investing, right? So these are questions which are honestly very deep philosophical or ethical question. I'm still searching for those answers. In person, I'm extremely high on integrity. I and my wife never given a single rupee bribe, never ever avoided a single rupee of tax. We pay whatever tax that is due to the government, and wouldn't want to do any of that thing. But that moral compass sort of probably, once it goes higher, you would see lesser and lesser. So incentive structure plays a powerful role, because when founders have lower stake, let's say founder has less than 10% stake, he would be incentivized to earn higher. He would be incentivized to कि यार कुछ मिल रहा है तो अच्छा है, क्या दिक्कत है. So I'll give you a very crude example of my brother explaining a philosophy when we had a debate at home. So my brother runs a hospital in Kotputli, small village near my home, Hasampur. And my father, who has taught me as a business and I create to whatever I know, he complained to my brother कि when our drivers take ambulances or our vehicle, so वो पेट्रोल भराने के बहाने थोड़ा चोरी करते हैं या पैसा निकालते हैं. And my brother said कि as long as it is limited, it is fine, because technically maybe they feel that I'm not paying them enough. The only way to solve, if I pay them, the problem is कि 1% का मैं बढ़ाऊंगा, कोटपुतली सबको पता लगेगा, and it become too much this thing. So you should warn them, but I don't. Papa wanted it taken harsh action, and my brother said it's fine because we are not paying. So that's the incentive mechanism. Because when founder को लगता है कि छोटा stake है, उसको कम पैसा मिल रहा है, उसके peer को ज़्यादा पैसा मिल रहा है, तो मैं भी कुछ निकाल लेता हूँ. In my opinion, that's not right. On part of the founder should not have done. Let's say that driver should not have done that. Now, whether investor knows it and allows it, or whether he should allow it, is a question.
Do you think fundamentally, like, other things can change, like in the model itself, to design better incentives? Like maybe like the funds should not be 8-year, 9-year funds. Maybe there can be 12-year, 15-year funds. I'm just giving an example, right? So something like that. Or, you mentioned founder salaries, right? Now, this is always up for contention with the VCs. I mean, they have to approve founder salaries and so on. And you think VCs should be a little more generous on that front, so that, the founder feels like at least they're economically safe, right? And they don't have to worry about those things, right? Because especially in the early days, they compromise a lot, right? So that, or do you think there should be limits on when you can do secondaries, maybe based on milestones? I don't know, right? Do you think that these kind of things can happen from a business model perspective itself to have better outcomes?
I'll answer in multiple part. I think the first thing is that integrity should be the paramount, and integrity of the founders or investor and ecosystem needs to be protected. I'll give the best example. The reason in India the problems are so high because our law or our law enforcement completely
very difficult to enact. Yeah.
Completely difficult. If you do something, you can't do anything against the founder. The recent example we saw where a US-based healthcare company, unfortunately founders were Indian. I feel ashamed to know that the founders were Indian. Where founders just overstated the figures. And that's very easy, right? Than a screen that's in a doctor's clinic, you are overstating the media. They got punished with a jail, right? Our own flag bearer, Mr. Ajay Gupta, on a circumstance evidence got punished, right? So Indian ecosystem needs to become more robust, quicker, faster, as well as penal mechanism need to go higher to protect integrity at both level, where founder do not doing stupid thing as well as investor not doing stupid thing. So that's first answer, because integrity is central to person. It's not necessarily can be imposed. If it's not imposed, then the reason the law is built to that key, if people are not behaving right, there's a law to take care, right? Now I've come down the incentive structure. I think it's extremely debatable of this thing. I would say at least on founder salary point, look, if you are burning capital, investor have provided capital. It's a debate. I had not come to the terms with the one side of this thing. My simple reason is, if founders should get enough money to have a mental peace. If that mental peace comes from 10 lakh, 15 lakh or 60 lakh or 1 crore, that number need to be mutually agreed between that VC on founder. If I'm a VC, I would figure out what number gives the mental peace to the founder, right? And whether the number is logical or unreasonable. Is as simple as that. Because if your founder is not at peace, how will you build the company? यदि उसको घर में 4 तकलीफें हैं, is best to borrow personally, or his self-esteem is being hurt by borrowing from parents or something, so that's a problematic, right? So that part needs to be sorted between VC, and there's no fixed answer for that because people's circumstances and this thing. You can define like seed पे होना चाहिए, series पे होना चाहिए, वो define कर सकते हैं. While it's disagreeable that a founder is taking more than its fair share, and company is burning money, right? On incentive structure, I think incentive structure exists for both people, founders as well as for investors. Investor, as I said, lot of investors aim to make money out of management fee, not the carry. For example, Dexter Venture, we want to be one of the first fund where we want to have lower fee on management fee side forever. That's basically the aim, because we want to put our skin in the game. So we want to have sizable capital from our in the fund as well as lower fee in the fund as a game. A lot of investors don't put sizable capital of their own. Plus, they want to make more money out of the management fee. But they justify that management fee he should invest the sponsor capital. How? There's no sponsor, right? So that should be fixed. Similarly, founders should also have skin in the game by ensuring that they have right equity. And if at all company is going for a toss, maybe sometime they will invest. Doesn't matter what valuation. You might do a rights issue where nobody participates. Founder participates 50 lakh at 1/10 value. Nothing. At least 2 things get fixed, right? If let's say founder has a low stake, like 5 to 10% stake, how do you fix it? Get your founder to invest some money in the company at lower value. Provide waiver on rights issue. 2 things happen. His stake comes up. Company gets capital. And stake goes up. There are very easy things to fix, but the problem is that ecosystem doesn't discuss and doesn't talk about these things.
What do you make of founders pledging their equity to take a loan and buy more equity?
Yeah, that's very interesting phenomena.
It's happened with
it's happened with, let's say, Oyo. The question is whether founder did it, whether founder did it at somebody's behalf. That's a question is debatable, but there's nothing wrong with it. If you think you're so this comes whether it's illegal, answer is no, immoral no, unethical no.
Does it typically happen in, let's say, promoter-led companies, like conventional companies where the promoter stakes and buys up more?
Conventional public listed company, it happens all the time. There is you can go on shareholding table and you find what the equity being pledged, and a lot of founder pledge, but most of them they're
pledging equity to buy more equity.
Pledging equity to buy their own more equity, they don't do that. They typically do it for other uses like build other businesses, etc. Right? Typically that doesn't happen, and I don't know the law position there. There may be law to pledging equity to buy your own more equity. But if you want to do it, that's completely okay. So let's say your company is valued at $3 billion time, and you felt that this equity is valuable, right? And you did borrowing at that value, right? If you want to buy your own equity, that means either you're buying because it's lower and you feel it valued. So as long as you're not hitting the covenant of the borrower, it's fine. There's no problem. Whether you should do that as a method to increase your equity, I answer would be no.
Why
not? Because your job, you are not a financier, right? You are not a bank. You are not a capital market guy. You are not a bond expert, right? So this is typically no financial expert. Your job is to build a company, right? So if you want to build a wealth, ultimately by buying equity, you are building wealth. It's better to negotiate a upside sharing structure. So P में ये हो सब होता है, equity में होता है, right? Like upside sharing. You negotiate that. If your aim is to create wealth, there are 10 other ways. Why do financial engineering? You are not an expert to financial engineering, right? You don't even know what kind of risk you are signing up. Right. So it's not advisable. It's not prudent for founder to do it. Is what I would say. It's not wrong, but it's not prudent. Is what I would say for founder to do it.
So we've just discussed many nuances, right, on the state of the venture ecosystem today. With all of these complications, right, and this sort of a landscape to navigate, right, we are seeing newer funds coming into the market almost every week, you know. So we run something called the Roundup, where we cover all the startup news, and we've been doing this for like 4 years every week. Quite rarely we miss. And this year, the unique thing is almost every week we've seen 1 or 2 funds being launched, right? I don't know what the total number of funds are at this point of time, but crazy, right? I would hazard a guess and say it's gone up like 2 times in the last like 2 years, at least, right? What is the logic of all of these funds coming into the market, right? Because what I personally feel is the number of fundable startups are very finite, right? And we have a case where, for example, Sequoia has some 2 point something billion to invest in India and Southeast Asia startups, so largely India basically, right? Axel has raised a fund. Bloom will perhaps raise another fund, right? And so on and so forth. All of this put together, maybe like, I think between the 3 or 4 funds, they might have $4 or $5 billion of capital to invest, right? In the next 2-3 years, right? How will these funds really compete in this market?
Yeah, multiple, again, fairly deep questions. I'll answer multiple folks. So first thing I'll say, you said that already the capital is so huge and the finite entrepreneurs to build. I used to cover in 2006 along with Saurabh, who was at part of Clear Capital, used to cover UK stock market on special
Saurabh of Coffee Can Investing.
Coffee Can,
just
right.
Say that as well.
So at that time, I'll tell name of few company. Paragon was a lender in buy to let. आप घर खरीद रहे हो लेट करने के लिए, उसके लिए लेंडिंग करता है एक ही लाइन के लिए, एंड इट वाज अ लिस्टेड लेंडर. ICP was a mezzanine lender. Okay, we had Charlemagne Capital, we had FNC, we had Aberdeen, we had Henderson. Mezzanine जो venture debt होता है.
Okay.
So ICP was a company. It was only lending for mezzanine. That's it. No other business, right? We had companies like Charlemagne Capital, FNC, Henderson, Aberdeen. All of these were listed asset managers, either aggregation asset manager or single asset managers, like Lion Trust, 2 fund managers running the company. If you talk about insolvency side, the law has come in India in 2016. In UK in 2006, we had companies like Debt Free Direct or Acuma or these companies, which were, the only job is to convince a borrower, ki boss, you are defaulting. Rather than defaulting, we'll come you and advise and we'll do a settlement with you and bank so that your default rate happens lesser, and for bank also NPA happen lesser, right? So if you see, do you see any of these companies in India? Answer is none.
Aberdeen, I heard after maybe 10
Aberdeen
years
you see in UK, but do you see any of the equivalent, any of the company? Let me give an equivalent of these company, right? So equivalent of Aberdeen, etc. Abacus, built by Sunil Singhania ji, or Marcellus, built by Saurabh, or 4P, built by Prashant Jain. That's equivalent now. Equivalent of ICP is all the venture debt fund that we see, like so Ulteria, etc. Equivalent of, let's say, lenders, there are specialty lenders which are coming. So it's not a question of entrepreneurship or number of finite entrepreneurs. Please understand, economy by definition is slow. India, my father's generation, in fact, even my father was worried कि मेरी job लगेगी नहीं लगेगी when I was in school and college. So our parental generation was only worried about financial security. The first time our generation is seeing, okay, in entrepreneurship also financial security can happen and you can do a wealth creation. There was no wealth creation. No one would do business except maybe some Marwadi community where there is a fabric of supporting each other, right? Otherwise, it was very, very hard for folks to imagine entrepreneurship. So opportunity set for a country like India is humongous. Unbelievable, and we need to tap on that opportunity set very, very fast. So apart from country's law, tax law, land label, capital reform, the capital has to be available and so it's the right direction, right? So answer is that we don't need to worry about ecosystem imbalance, that capital will, the financial system or economic system is self-balancing correcting system. Sometimes you need a regulator like RBI to keep the inflation in check, or deposit growth versus credit growth check, or somebody like you need a SEBI kind of system to keep an FNO in check, right? But otherwise system, it would probably self-correct itself. So we don't need to worry about that.
You're saying there's enough opportunity, or rather there's enough places the money can be deployed.
Absolutely. And given we have 3 more things now, AI, internet and technology and globalization, you can build sitting in India for anywhere. Our UPI being exported to African countries or Singapore country, etc. Right? So the thing is, you can build a lot. And India, given the nature of hard work, you extremely efficient allocator of capital, being talented, English educated, we have the best opportunity in the world to build it. So this money coming in is absolutely fine, and let more money will come in. Right now, तो अभी HNI से आ रहा है, अभी तो retail से और आने लग जाएगा. Once SEBI actually eases. The angel fund license that SEBI gave was actually a step in the direction, which is I call as ultra HNI, no, professional HNI, what I call as who are putting money. So that's not a worry at all. So there is enough opportunity for these things. The second phenomena, which is second order impact, which is not analyzed, And I wish both, let's say, investment banking industry as well as the private equity or venture capital fund industry report these data. So, for example, our industry doesn't report one data, investment banking, closure rates, or value added to an entrepreneur or entrepreneur's wealth created, some of those data, right? Or success of the company that we advised. These are data, let's say, they should be reported in investment banking. Similarly, funds should report who are the actual GPs or who are the anchor, who are the co-GPs. There are a lot of funds in India which are being created, which are fund where they have a co-GP, which is a family office, where the sponsor who has special rights in IC or hiring or how the fund is being managed, right? Why that is happening is very interesting to note. Indian venture capital industry valuation and Silicon Valley or foreign capital valuation different. In foreign, countries got freedom a lot better, like 300 years back. And their institution, like we have EPFO. Yesterday we saw a huge focus on EPFO as well as NPS. Those institutions got built. Like Canada has 4 pension funds or like OTPB. So those got huge capital, and those market matured where those institutions had 1.5% to 10% allocation toward alternative asset. So fundamental provider of capital for those venture capital fund or equity fund were those institutions which exist in US, Canada, Europe like Amsterdam, etc., where they provide capital, right? That provider of capital was never interested about fee. You had 2% fee, management fee, as well as carry. They said we need to choose the best fund manager. We don't worry about a fee. Indian family offices are very hard on negotiation. They value every rupee that is going and generating. So they realize that, okay, rather than giving 2% fee, so if you do the math on the, let's do the math right now. If you invest 100 rupee in a fund, 2% annual fee for 10 years means 20 rupee. Chala gaya. Then there are expenses and the setup cost. Annual expenses, which are all about this management fee, by the way, right? So, mota आपका 22 से 27 रुपए चला जाता है, whatever money you invest in a fund, right? Which means if a fund has to generate 3x, which is a very reasonable expectation in 5 or 7 and 10 years, right? It will generate this 18% IRR kind of thing after carry and taxes, etc. The investor needs to generate 5x, which means this instrument will take higher risk. Now, Indian family offices, given I interact with a lot of families, and I think, why the hell I need to give 2%? यदि मुझे 100 करोड़ डिप्लॉय करना है या मुझे 500 करोड़ डिप्लॉय करना है, I may either hire a team, which a lot of family offices are doing, or I actually can find or co-hire an entrepreneur who becomes a co-GP with me. So rather than this guy joining somebody else, I'll give him enough freedom. I would be just an IC or maybe some hiring decisions or some sort of sponsor level decisions, etc. Let me build it along with this guy. And that's the reason you see the proliferation of a lot of funds. And that will continue to happen in India. So all the newer funds that you launch are getting created with blessing of a very key anchor, in my opinion. There are very less funds who are getting created where they don't have an anchor investor, a huge anchor investor backing them. And they actually have went ahead. And another thing that had done well, where we need to thank the entire Thai NASCOM community, people like Saurabh Srivastava and equivalent, who have argued with government over the last 10 years and created that 10,000 crore fund of fund. That has become the biggest boon. Because that fund of fund have been an LP in a lot of new funds, SIDB and SRI. And that has seeded a lot of funds. Because if you do the math, for a person to become fund manager, you need a fund size of minimum like 60 crore to like 300 crore. And at least the journey has started, right? So that basically has spawned the journey of all the new fund that we see coming to the country. The interesting thing which I tweeted on your tweet was, it's easy to create fund one. And it's not easy, let me not say it's easy. Creating fund one is not a definition of success. Creating fund four is. Because fund one में पहले invest करोगे, अपना track record बनाओगे, फिर आप fund 2 बनाओगे, which will be done on DVPI, which is probably okay. But fund 3 and fund 4 के time पे DVPI become important. So if you have not created fund 4, you won't be able to create an institution. So we'll create a lot of funds, but whether we'll be able to create an institution like Sequoia Excel in India, that's still to be seen. On P side, it's at least happened, at least for 2 funds, or I can say Chris Capital. I think they're fund 9, fund 10, Kedar Capital, both are excellent fund. When I go to Singapore, USA, I talk to some of the LPs there who say, can you make an introduction there? Right? Similarly, like A91, hopefully they should do also pretty well. So we think there are some institutions which will do very well in India as well on the VC side, but that those institutions being created still 10 to 15 years out.
What makes a really, really good fund? Like something like an Axel, right? Because I mean, I've had investors on the podcast, and there's a huge overlap in terms of what they look for, right? Large enough market, great team, good product disruption, let's say, right? A track record, etc., etc. I mean, these are like if I look at maybe like 10, 15 VCs that I've hosted on the pod, I mean, pretty much everyone will have 80% of those covered, right? So what is the alpha, right? Like what sets apart someone who's truly phenomenal from someone who's just about okay? 3
things. So I would say we have homegrown fund. Excel is still a fund launched by Indian entrepreneur, but under a brand which is foreign brand.
Bloom.
But if I talk about homegrown fund, we have Nexus, excellent fund. We have Bloom, we have got India Quotient. The newer fund are like Special Invest, like Still Risk. So there are all newer homegrown fund which are hopefully are doing well and will do well. I would say 3 things for any fund manager. First, still stability of the team. So a lot of time team is not stable when incentive structure is not aligned. If you are not able to have right incentive structure, look, you cannot stop anybody's ambition. If 2 people work together and then people become ambitious, they want to create a new fund, it's fine. But when it's happening because incentive alignment issue, there's a problem or a personality issue. Like in any fund starting guy, there's one guy who's senior, right? But so whether you can create an institution on team side, where that institution, because fund is inherently partnership structure, right? So whether you can respect that institution, and the responsibility lies on either the GP, the main GP, or the co-GP who have created the fund. Can they do that? The second thing is, can they build immense trust or faith in the entrepreneurial ecosystem? And this is not just about investing in great companies that way. Are you being empathetic to the founder? Are you ensuring that you're not ghosting the founder? Are you ensuring that you're getting back to the founder? Are you communicating your thesis right?
But do you think that is still a differentiation? Because I would expect that अब तो इतना तो सीख लिया होगा सब लोग.
सीख लिया होगा means entrepreneurs
I mean, like investors.
No.
Right?
We see,
I mean, because I would have definitely said that, okay, maybe 10, 15 years back, right? It was something unique to be founder first, right? Be empathetic, be transparent, all of those things. I mean, you're from that world. So, I mean...
Look, everyone says founder first, but the problem I'm talking about is a very, very deep problem in ecosystem. So, ghosting is the biggest problem. Not getting back to founder when founders send the pitch is the biggest problem. Not being fair to founder during negotiation of terms. The fair is very difficult to just develop. Let me just define it. Let's say you feel that founder needs money badly, and you actually do more work and diligence. There are certain issues crop up and you actually renegotiate the valuation, right? That's a bad faith thing. And that happens in this current market a lot. We see a lot of investors doing that. That's wrong, right? If you're founder and fundable, walk away, right? That's my definition. So I think there are a lot of problem still. So as of now, this is known as more like which fund has invested in how many good quality entrepreneurs, which has actually raised future funds or become unicorn, etc. But I think when we'll really have a grown institution, even these things would merit a lot. Whether founders, where investors are ensuring that founders are not ghosted or founders get back. For example, in Dexter Venture, it's a very small effort, micro VC, not even started, right? We ensure, and this is the reason I'm doing that, because before starting, I want to fix these. We ensure that we get back to founder within a week. We try to ensure that we close the loop, we don't ghost them. We might take more time and diligence because a lot of my personal money is sitting in the fund. But we're just trying to ensure that we are not sort of doing things which I as a human or an entrepreneur will feel bad about. It's simple. So one, building extremely high brand equity in entrepreneurial ecosystem And third, which is very natural, that ultimately you are taking money from investor. Are you generating returns for investor, not just TVPI? So whether you are able to generate market-beating returns, which an investor or LP can get elsewhere, and can you generate that on a sustainable basis? And these are three things that are the most critical. Other things is whether you are operating in an ethical way, which is seen when markups happen or down rounds happen. So I met an LP in Dubai, and the most interesting conversation, they are like, they're invested with like top 10 VC funds, and one of the things that they complain about Indian GPs is that we are probably invested in, let's say, maybe 3 to 4 or 5 GPs. One of the things we found very funny is that same company being reported different value by those my GPs, and it reflects the character of the GP to me, and it's very certain that I'm not going to invest in that person again. If I know that person is just trying to mark up because he has to show higher TVPI, right? We would expect more transparency, honesty from those funds. So I think those are the reasons which would happen, which will differentiate the firm. India still needs to see world-class institution, homegrown in world-class institution. Indian VC is my opinion.
Vinod Khosla has this quote, right? I mean, the numbers vary, but he says some X percentage of investors add no value. Some Y percentage of investors actually add negative value to a company, and very, very, very few percentage of VCs actually add real value, right? How can an investor add value to a founder, like beside the money itself?
I think I have huge respect for Vinod Khosla. He's a iconic entrepreneur, investor, and somebody who doesn't afraid to speak his minds and open to speak also in public too. There are very less people in India. We see somebody like Sanjeev Chandani. Not many people do that. I would say investors primarily add value to either entrepreneur or investor by putting systems in place which naturally come as soon as the funding round happen. Systems like there has to be good quality auditor or intern auditor or the CFO or MIS, etc. Those are enough levers to provide value to founder, because founders in India are too busy in execution. Sometimes they miss the larger picture thing, which are very, very critical in building the institutionalization. For example, last 2 years, one of my very close friend and few other friends said that you need to institutionalize. And honestly, institutionalized production is hard. You need to away to do that. So that happens. Rest is founders are lonely and founders are not experienced things. As an investor, you experience things, right? So you don't need to give them gyan on business, on strategy, but you definitely bring the insight, because founders are too busy executing. So if you can bring an insight of something happening in world where founder is not exposed, so that something should be done. Maybe if that company is using technology in this way, and maybe you do that. Second thing is focus. A lot of time founders are their biggest enemy because of decision risk. Most founders are susceptible to decision risk. I'll define decision risk. Let's take example of Suzlon. When Suzlon fool that is very powerful, it went ahead and acquired Repower and did capex where the demand did not exist, right? Because you feel overconfident, or I'm not sure I should public. Let's Mr. Anil Ambani. He got equal wealth, but today there's no wealth left, right? Probably it was part of decision risk. So founders sometimes do decision risk. So investor and board can graduate and guide founder on decision risk as well, right? But giving micro knowledge, or I think the worst thing a lot of young investor do is they start comparing a portfolio founder to other portfolio. That guy raised capital, boss. You should also do. You are not performing. Or the guy is doing so much beta. Arey baba, that company different, this company different. Don't give gyan. If you want to give gyan, don't compare randomly and give gyan on contextual. Be helpful on B2B connects. Be helpful on hiring, which a lot of investor anyway do. That's hiring the biggest value add that investor provide. But be this thing and open the doors for, let's say, if you have connection in US and founder wants to do that. So those are value add that can provide, but these are more like tactical value add. The significant value add comes stand with founder. I saw a tweet by a founder named Anil, his founder at 247, and he tweeted about Sanjeev. Stand with the founder. Once you invested, it's not just about transactional. Stand with founder in their thick and thin, in their happiness and sorrows. So that's another thing that if you can do, can you keep founders mentally busy? If let's say, I'll give example of my own family, right? Anuradha, my wife and co-founder Dexter Capital, she's building Dexter Venture now. She is building Multibhashi and she's still building. And Multibhashi reached to a stake in EdTech where taking more money meant you have to burn capital and grow to a particular this thing, which could put the survival of the company at a risk. And if you degrow and become profitable, that would build the company slowly. Dr. Malpani, excellent human being. I have not come across a person in terms of who is extremely mature. Dr. Malpani and Anuradha wouldn't tell anyone, none of the investors, and went through a lot of turmoil for more than 9 to 12 months. What do I do? And she would ask me, from our own capital, we should just return the capital, right? Something like that. Dr. Malpani actually would be a guide and angel to her. You don't need to worry. You keep building. He anyway promotes frugal entrepreneurship, so his bias is towards that anyway. So he kept building and he actually encouraged her ki if building doesn't take too much of a bandwidth, if you want to do something with your time, absolutely okay. So those kind of investors don't exist in India. Too many investors, like they exist. So that should happen. So there's a lot of ways founders, investor can add value. Being their personal friend, by personal coach, ensuring founders that they're the back of the founders. But not by giving them, telling them, ye karo, na karo. That's my way to tell.
Given that people are such a big determinant for success in this whole business, right? I mean, I feel like definitely it's really helpful to index more on the people front for sure, right? And I think the real value add, I feel like VCs can also add is the thing that they see things in aggregate, right? I mean, a founder is too close to the product, maybe too close to the business, too close to his market, but VCs are able to see things in aggregate. They see that from 1,000, 3,000 feet view, right? That is one thing. Second thing I think is that VCs can also see the startup as a financial asset, which is also necessary, right? I think very few entrepreneurs, perhaps like negligible amount of them will have the heart to see it as a financial asset, right? Maybe the more mature ones, right? So those are two things I would say. All right, so Devendra, I have way more questions to ask you than we can fit in whatever time we have at this point. In fact, I mean, the camera is overheating, as our producer just said. We'll definitely record a part 2, but one of the most fascinating conversations I've had in recent times. Thank you so much for coming to the studio, and looking forward to a part 2 very, very soon.
Thank you so much, Roshan. It was a pleasure for me to be here. More than happy to be come again and sharing my thoughts.
Awesome. So this concludes part 1 of the conversation. I hadn't planned a part 2 or a part 3 perhaps, but yeah, we'll record a part 2 and we'll be back soon. Thank you for joining us, and hope to see you again.